Good afternoon, good evening, good morning, everyone, depending where you are. Welcome to today's Future of Financial Information webinar series. It's my great pleasure to introduce Yijun Zhou from Baruch College, our presenter today, as well as Yuehua Tang from University of Florida, who will discuss. And the topic today is information specialization among institutional investors and what that means for market efficiency. So you already have the word information, the title of the paper, so clearly it had to appear in this series sooner or later. So we're very happy to have Yijun with us today. Just some basic housekeeping. So the presentation will be about 30 minutes, and then we'll hand over to Yuehua for the discussion, about 15 minutes. And at the end, we will have a 15 minutes Q&A session. But don't sit on your questions until the very end. Feel free to submit them through the chat. So I will be keeping an eye on the chat throughout, and then we'll make sure to get back to your questions at the end. And now, without further ado, Yijun, please, the screen is yours for 30 minutes.
Yeah, so thank you, Michael, for organizing this meaningful event, and thanks a lot for giving us the opportunity to present here. And also, I'd like to thank you in advance for your discussion. So let me share the screen now. Yes. The paper I'm going to present today is Information Specialization, Strategic Complementarity, and Market Efficiency, Evidence from Institutional Trading. And this is a joint paper with my PhD advisors, Massimo, Massa, and Zhang. So our paper is motivated by a key concept in finance, firm-specific information. So this is very important as market efficiency relies on sophisticated investors to process firm-specific information. But the question is, what exactly is firm-specific information? By definition, it's information of each specific firm, but it can still be of very different types and be very different. So for example, here, so there are a bunch of examples. The first one we can see is NVIDIA inference breakthrough makes conversational AI smarter, more interactive from cloud to edge. It's a firm-specific information of NVIDIA, but it's about its product. Then we can also see Disney posts a rebound as tourists return to its theme park, firm-specific information from Disney about its revenues. And also two other examples, Amazon makes push to reduce worker injuries, and another information from NVIDIA. So, but it's about its M&A, its acquisition of Mellanox. Finally, here we can see a bunch of analyst stock upgrades of each individual firms. So they are all firm-specific information of different firms, but they are all belonging to the analyst stock upgrades. So as we can see from the examples, firm-specific information is very complex, and they can be classified into many different news categories. This motivates our research questions. The first one is, do skillful institutional investors specialize their trading in a few categories of news in practice? So here we have two competing hypotheses. The first one is an informed generalist hypothesis. Well, the informed investors behave like generalists that process all the categories of news in the market. The competing one is the informed specialist hypothesis, where the informed investors behave like specialists that focus on only subsets of the news categories. So ex ante, both hypotheses may be true, and it's an empirical question that which one is closer to reality. And given the answer to the first question, we ask a follow-up question. What's the implication on market efficiency? Here is the preview of our main findings. So first, we find that skillful institutional investors specialize their trading in a few categories of news. So here, there is a positive correlation between skill and specialization. So we do not distinguish the two mechanisms. The first one is that skillful investors self-select to specialize, or specialization causes their skills or contributes to their skills. So the tool may exist, but the key takeaway is that information processing skills may not be easily transferable across different types, different categories of news. And furthermore, we find that such information specialization may reduce market efficiency, mainly from two channels that I will discuss later. So the first one is that the inattention of even a small fraction of investors can hinder the information dissemination in their specialized categories of news, while we do not see this phenomenon for generalists. And moreover, the information dissemination of news in other categories may also be hindered due to a strategic complementarity channel as proposed by Goldstein and Yang 2015. So in the next 24 minutes of this presentation, I will first talk about the data and variables that we use in this paper. And then I will talk about the empirical analysis to the first empirical question, first research question by linking specialization with performance. And then I will discuss the implications on market efficiency. And if I have time, I will talk about robustness checks, then I will conclude. So data and variables. So to examine how investors trade in different categories of news, we mainly combine the Ravenpack news dataset with the external trading dataset. So Ravenpack is a widely used news dataset where it covers news articles from major news resources like Wall Street Journal and Dow Jones and so on. So it's news about each specific firm. Moreover, Ravenpack groups the firm-specific news into 15 news categories. So for example, we can have order imbalances news, insider trading news, product and services news, analyst ratings, earnings, labor issues, M&A, and so on. And External is a trading database of a small group of a subset of institutional investors in the market. It includes the daily trades of each institutional investor in each stock. A more detailed introduction can be found in Packet and Yen. So the key step of our paper is to link the two datasets where we label a trade by an institutional investor as news-related trading if there is news recorded for the stock on the current or previous day of the trade. Since news is categorized into different categories, then consequently, the news-related trading by each institutional investor can also be categorized into one of the 15 categories. Then we want to study then we can observe how each institutional investors trade in different categories. News categories, then we can categorize institutional investors into specialists and generalists. So specifically, we build a news category concentration index. So by observing the percentage of news trading in each news category by each investor, we build an index, concentration index like the Herfindahl index, which is the sum of the squared percentage of trading in each news category. And then we can sort institutional investors every quarter into quintiles based on this concentration value. And the investors in the lowest quintile, quintile 1, are considered as generalists, while other investors classified into quintile 5 are considered as specialists. And here, we can see that the average news concentration value differs a lot across different quintiles. And for specialists, the concentration value is 44.9% on average. So it means that specialists only concentrate their trading in 2 or 3 categories of news. So we first observe large heterogeneity, and then we find that this classification is also quite stable over time. So specialists in one quarter are likely to be classified as specialists in another quarter. Then empirical tests. So given the large persistent and different patterns in trading in different news categories, the economics is not ex ante obvious. So to test the informed generalist hypothesis versus the informed specialist hypothesis, we will conduct 2 tests. So in the first test, we look at the overall portfolio performance of specialists and the generalists. And in the second test, we look at the out-of-sample predicting power of their trades. So first test, portfolio performance of specialists versus generalists. And so for each investor in the external database, we can only observe their trading data, but we keep track of their trading in each stock over time using the first in, first out rule, and then we can build their portfolio and compute their real portfolio return every month by holding their actual holding periods in each stock. Then we aggregate the portfolios of all the investors in the quintile to obtain the quintile level real portfolio performance. So this table reports the characteristics of monthly portfolio performance for each quintile. And we can see in the first row that the average monthly return increases with the concentration or specialization quintile. For generalists, the average monthly return is 0.56%, while for specialists, the average monthly return is 1.14%. And the similar patterns can be observed using the DGTW return or alpha. And when we construct a new portfolio, this one, we buy the portfolio of the specialists and we short sell the portfolio of generalists. And we can obtain a new portfolio with a monthly return of 0.58%. So this test implies that generally specialists outperform generalists in general. And this is also economically significant. And then the second test. So the first test shows that specialists outperform overall, but we want to provide more direct evidence that specialists are more skillful in processing the firm's specific information. So to do this, we examine and compare the stock level predictability of their trades. And we conjecture that specialists trading can better signal the superior firm-specific information. So we look at the buy positions and short positions separately. Here is the result on the buy side. So we regress the stock future returns, like 1 month, 2 months, or future 6 months, on our main variable of interest, the trading, the difference in buy orders between specialists and generalists. We also include the aggregate buy by specialists and generalists to control for the the common information. And the results in the table show that the coefficients of the buy difference in buy are very positive and significant, which means that the buy positions by the specialists can better predict stock future returns than the buy positions by generalists. So if specialists have larger buy orders, buy positions in the stock than the generalists, then the stock will have higher future returns in the next 1 to 6 months. And this suggests that specialists do have superior signals, the firm-specific information, and the higher out-of-sample predicting power than generalists. However, we don't find such evidence in the short side, so the better performance mainly comes from the long side. So this is the answer to the first research question. We find evidence to support the informed specialist hypothesis. Then the second question is, what's the implication on market efficiency? So here we mainly explore two economic channels. So the first channel is a category inattention channel, where a temporary shortage of specialists' attention can directly hinder the market informativeness about their specialized firm aspect. So this is because the results from previous tables suggest that the information processing skill may not be directly transferable across different types of news. That's why the specialists outperform. And in addition, we know that even institutional investors can have limited attention. Therefore, if specialists that specialize in trading in one news category are distracted by some exogenous attention shocks, then other specialists and generalists may not easily transfer their skills to these specific categories of news. Then the information in this specific category may be processed less promptly in the market, and the information dissemination will be delayed. That's the economic intuition. So to test this conjecture, we first need to measure the inattention of specialists. We follow Camp, Manconi, and Smart 2016 and use the fraction of stocks in the portfolio that experienced extreme returns in the specialist portfolio in the previous months to measure the inattention of each specialist. Then we aggregate across all the specialists that used to trade in each news category. And then we examine how stock prices respond differently to the information with different levels of specialist inattention. So to proxy for the information content of news, we use the sentiment score, ESS, from Ravenpack. So a higher sentiment score means more positive the news is, and while a lower sentiment score means indicates a more negative news. Then we estimate this following specification. So we regress the stock return, the digit stock return after on the news date, and 20 days after the news on first the information content, ESS, and then the overall the inattention level of the specialist in this category, and more importantly, the interaction term between the information content and the specialist inattention, so the gamma 1, and we conjecture that the inattention from specialists will lead to market underreaction to the news. So here is the result. So first we can look at the first row, the coefficients on the information content, ESS. And we can observe positive and significant coefficients from the news day T, and then T+1 to T+20, 20 days after the news. So it means that the market reacts to the information content in the expected direction, in the same direction on the news date. And moreover, the price continues to drift in the same direction after the news. So this is the post-news drift, which is similar to the post-earnings announcement drift we usually know. And more importantly, so let's look at the coefficients of the interaction term. So here we can see that the coefficient, the gamma 1 on the news date is negative and significant. It means that when specialists are distracted, then the speed for the price to incorporate the firm-specific news gets significantly reduced on the news date. And moreover, we find that the coefficients are positive and significant in the post-news window, which suggests a larger post-news drift after the news. So to visualize the effect, so here let us look at this figure. So the blue and gray line show how the news gets incorporated into stock prices with low inattention from specialists, while the orange and yellow line shows when specialists are distracted or with high inattention from specialists, that the news, the information and dissemination is significantly reduced on the news day T, and we observe a larger drift after the news. So it means that with specialist inattention, the information dissemination is delayed, and which means the market efficiency may be hindered. While this is the effect for the specialist, then we conduct a placebo test by examining the inattention of generalists. And here we expect that the inattention of generalists would not have the same effect as specialists, because for generalists, when they are distracted, it's relatively easy for other generalists or other specialists to fill the gap and process the information. So indeed, we repeat our previous analysis, but we replace the specialist inattention with the generalist inattention. And most of the coefficients are not significant. And so we don't find information of reduced information dissemination with generalist inattention. So this suggests that the information specialization may lead to a segmented information market, and which may hinder the information dissemination in their specialized categories when specialists are distracted. So this is the channel, the first channel, a direct channel that information specialization may hinder market efficiency. However, there can be a indirect effect from another channel, channel 2, the strategic complementarity channel. So from this channel, the information specialization may further affect the information dissemination. So this intuition is inspired by the uncertainty reduction effect proposed in Goldstein and Yang 2015. So roughly speaking, the information uncertainty faced by specialists in one news category will get decreased when specialists in other categories process more information about other aspects of the same firm. And similarly, or if the information uncertainty faced by the specialists in one category will get increased if specialists in other categories process less information. Therefore, so for specialists in one news category, say category I, the inattention of other categories specialists may increase their uncertainty, which is not desirable and which will consequently reduce their information to process information in their own news category, category I. So to study this channel, we further extend our empirical analysis from the covering specialist, the focus of previous tests, so specialists that cover a specific category, to non-covering specialists. Now we look at the specialists that process information in other news categories, excluding the focal category. So non-covering specialists of one category are not processing or are not covering this particular news category. And as we showed previously, the inattention of the covering specialists will directly delay the information dissemination in the corresponding category. Therefore, to test the strategic complementarity channel, we focus on the case where the non-covering specialist inattention, but not that of the covering specialist, gets exogenously distracted. And we find that, so we repeat the analysis, but now we focus on the inattention of the non-covering specialist when the covering specialists are not distracted. Then we find that when the inattention of a news category's non-covering specialists increases, then the market reacts to lesser extent from news state T and to T+3, even though the news category's own covering specialists are not distracted. So to how to understand this result, so we know that the non-covering specialists, they are not covering this news category, so they do not trade in this news category. Therefore, they are not supposed to process information in this category, and their inattention should not directly affect the information dissemination in that news category. And also we know that the covering specialists are not distracted at that time. Therefore, the delayed information dissemination is likely to come from the indirect effect through the strategic complementarity channel. So when the non-covering specialists are distracted, and the incentives for the covering specialists to process information may be reduced due to the strategic complementarity, even though they are not subject to inattention shocks by their own. But through the strategic complementarity channel, we can also observe reduced market efficiency. So this is the second channel. And finally, let me talk about two robustness checks. So one concern of our information specialization is that it is capturing some of the existing measures of the existing papers. So such as the trading reliance on news by Kapachek and Zhou. So here we use the percentage of news-related trading as a measure of the investors' trading reliance on news. And then we double sort the investors into, so we can see here, we double sort the investors into 25 groups by the trading reliance on news and the news category concentration. And for a given trading quantile of trading reliance on news, we can still observe that the performance increase with the news category concentration. So the specialists always outperform generalists, even after controlling for the trading reliance on news. And the second existing measure that we consider is the industry concentration by Kapachek, Zhang, and Lu. So they use industry concentration to measure the skill of institutional investors. So we follow them and use the portfolio trading in each industry to construct an industry concentration measure. And we find that after controlling for the industry concentration measure, the portfolio returns still increase with our news category specialization, which means that our information specialization measure is different from those existing measures. So finally, let me conclude. So in this paper, we first find that more informed investors tend to process information in fewer news categories, and consequently, this information specialization may hamper market efficiency from two economic channels. First, the inattention of even a small fraction of informed investors may impede information dissemination in their specialized category because it's difficult for others to transfer their skills into this specific category. And moreover, we find that other categories may also be negatively affected due to a strategic complementarity channel which stems from the uncertainty reduction effect. So in overall, our results suggest that the market for firm-specific information is likely to be segmented, and which on one hand may improve the performance for each group of institutional investors, but it may have negative implications on market efficiency. And that is my presentation. Thank you all.
Thank you very much.
And look forward to the discussion by Yuehua.
Absolutely. That's our next item on the list. But first, let me thank you, Yijun, for this perfectly timed presentation. Makes the job of the host very easy.
Yeah.
And now, indeed, let's give the screen to Yuehua for the next 15 minutes, and let's hear his discussion.
All right, thank you. All right, it is a great pleasure to be here and to discuss this interesting paper on information specialization and the market efficiency. So let me first give a kind of a summary. Yijun did a very careful and precise job on what the paper is about and what did it do. So the main question is how information specialization and strategic complementarity affect market efficiency. They will show evidence on information specialization first, and then they will study this prediction on the theoretical prediction on strategic complementarity and what the implication for market efficiency. How did they do it? They use the Abenozer institutional trading data or external, either name is fine, combined with the RevImpact news data. So the result they have, first one is investors that trade fewer news categories, they seem to perform better in their portfolio performance. And second, also it's the more novel part of the paper, and they look at inattention of those specialists, or what they call specialized investors. And they show that such inattention can have implications for market efficiency or price discovery. There are two channels. Number one is the direct channel, where you specialize learning about the, let's say, the product demand of a company. And if such specialists have inattention, such news will be less likely to be incorporated in the price. Or the more sexy prediction is the indirect strategic complementarity channel. I'll come back to that in slightly later. And to show evidence, they try to do tests on both sides. So overall, this is a very nice paper and very ambitious. All those information theories is very convincing when you read the theory, but when you test it, it's quite challenging. And from my personal experience, and I definitely enjoyed reading it. And I thought this is a clever use of the Abenozer data combined with RevImpact. Another paper by Ross Wormers, they also combine Abenozer and I believe there's also news data, is IFS 2019, if I'm not mistaken. So, but the research question is different. So before I get into very detailed, what are the big picture? So you know that in practice, investors are specialized. It's just like researchers in this room, okay? Some people specialize on corporate, others specializing asset pricing, others specializing in machine learning, okay? So that's true in practice. So the typical wisdom is they specialize in certain area or assets, right? So you could specialize in industry, like their industry concentration paper by Kakbzek, Shime, and Jan. And Massimo also has, the author of this paper also has a paper on using Sweden data because on portfolio choice and industry. Okay, so that's kind of a specialization, right? An area or an assets, or you could specialize in a certain geography region, a country, like all the home buyers studies, or like local buyers, so the home buyers literature is huge, and there's local buyers literature is also big. And even myself, I have a recent GFE on kind of mutual fund managers specializing in a certain area for multinational firms. You have a multinational firm, part of the operations in US, part of operations in Sweden. Different people might have different edge on the news coming from two different locations. And there's nice theory by Newborough and Wedkamp, and it's like you're choosing which asset to specialize. Okay, so it's slightly different from this paper. This paper is about the same assets, but different dimension of uncertainty. I'm talking about the same company, but the uncertainty of news is coming from different dimensions, right? Different locations. Look at the NVIDIA news and Yijun showed, right? So in the big picture, the prior studies, including my own, mostly focus on investors' behavior, their portfolio choice, and their portfolio performance, right? They don't offer much insight on the impact of the impact on market efficiency, the impact on information dissemination or price discovery, right? So that is the most unique contribution of this paper. So it has a clear agenda, and the authors are very clear that's what they want to achieve. And it's also challenging, but this is also novel. So I thought it's kind of a novel idea to test those predictions regarding strategic complementarity, regarding market efficiency. So in that sense, I think if the authors are able to achieve those goals, and the paper will have a new contribution to the literature. So what I have next, I have some thoughts on the paper where some of them about conceptually, some of them about results or execution. I will go through one by one, and hopefully that could be helpful for the authors to kind of move forward and further and push along the project, right? So the first thing is information specialization. As I mentioned earlier, right? Information specialization is slightly different from the usual concept of specialization we had, right? Specializing in a certain industry, on a certain company, on a certain area. Right here, is about one type of news, right? So, and the one question, although it's not like super important for the paper, one question I have is, what are driving those specializations across different types of news? Right? Some specialize on about product demand, some specialize on other things, right? So the authors, they're using the RevImpact data, right? RevImpact has this news category. They're using those categories to measure expertise, right? I understand why they do so. I understand that it's convenient to do so, but on the other hand, it's also like intuitively less when I look at those categories, right? So those are the 15 they choose, right? Order bindings, insider trading, product services, analyst ratings, earnings, revenue, labor issues. It's the more I look at it, the more I ask myself, are those categories really suited to measure specialization? Why? Here's something I can think of, right? So to cast some doubt, right? Those are non-mutually exclusive. Earnings, news, and revenues, how do you differentiate, right? Am I specialized on only on earnings, not on revenue, right? Even like product service, right? It could be related to earnings and demand and such, right? So, or sales. So they're not mutually exclusive. And that's quite important because we're going to differentiate one from another because they're specialized on different things. Right? So, and second, some are quite broad, like from an information sense. Let's say analyst rating. Analyst rating itself is just like an event, but analyst rating the outcome up and down and upgrade or downgrade. Analysts are using all kinds of information. I mean, the information analysts use could be from all kinds of information, right? So it's not like, I don't know, like if you narrowly interpret it, I can see this is one type of news, but analyst rating contains all kinds of information in it, right? So, and some are not well-defined areas, right? So, right, investor relation and like price target. I know that those frequencies are smaller in terms of, those categories are smaller in terms of frequency. So I just feel that ideally, in order to make it more convincing, you want to use some economically motivated classification. I don't know whether you want to do some textual analysis or regrouping of these news categories into, I don't know, it's cash flow related, demand, technology, and other things. I mean, I want something to be parallel and non-mutually and mutually exclusive and economic and motivated, rather than just use whatever random pack has. Okay, right. So second, the measure is use kind of a Herfindahl index type of measure, right? So that's a news category concentration. When I look at it, right? So this is the HHI. HHI equals to 0.45, and that's super concentrated. I think Yijun mentioned they're only trading in 1 or 2 news categories. I mean, that's actually quite surprising to me, right? Why they only specialize on one of those 2 categories, and I thought, you know, it'd be more broader than that. It's related to my former the previous comments, right? So also I have other questions. How do you define an investing advisor? There are account level or fund level. There are also family level or institutional level, right? So how many institutions are there? And those are all important. You want to, because you're testing market efficiency, you want to make sure that the mass of investors is enough to move you know, the prices, right? So, and also do specialists continue to specialize in the same news category? You show that they continue to be specialized, especially in the same news category. I believe so, right? And if you look at the trading characteristics, I do find, except turnover, others are very different. I think you want to dig in deeper on those things, right? So how much do you rely on news, and you have a robustness, but you want to ex ante be very transparent. All right, so next is on their table 3 on portfolio performance, and they show that specialists tend to outperform. And one thing that jumped up to me is I was surprised to see that the T-stat for Q5 minus Q1 is actually way higher than the Q5 itself. So those 2 are mostly quite precisely estimated. And this is testing against 0. And this is testing against a positive mean with quite precision. So it's hard for me to imagine you'll get a T-stat of even higher. I would double check. I mean, I'm not saying this will not happen. That's definitely surprising. And also, those are like institutional performance, portfolio performance. There could be 0 correlation. You want to adjust for those things when you test against 0, right? So, and this evidence is also consistent with like Manubra and Vedcamp, right? Specialized investors tend to hold, they tend to deliver better performance and also have more concentrated portfolio. But here's maybe it's more concentrated trading. You know, you know, you guys don't mention this at all because you're going after, you know, a different theory, but I thought it was interesting to mention. So, and then the next,
yes.
How much time I have?
About 2 minutes.
Okay, so let me skip my comments number 4. Let me talk about how to test strategic complementarity. Right, in the Grossman-Stiglitz world, everyone's learning about the same information. Only the top dog has meat to eat. Okay, so there's strategic substitutability, but Goldstein showed that multiple dimensions there are strategic complementarity because of this uncertainty reduction effect. Let's say yesterday there's a big sell-off because of market, you know, because of macroeconomic like uncertainty. Even today you have news about like Nvidia, I will not trade them. Okay, so that's exactly the uncertainty reduction effect, right? So, but Goldstein and Yan, they show this is not unconditional. This only happens when the uncertainty reduction effect dominates. So I want you to test that hypothesis more strictly. You want to identify scenarios where the uncertainty reduction effect are large. Let's say some people specialize on M&A news, and there's a lot of uncertainty about it. Right? That's where the uncertainty reduction effect might dominate, right? And not only you want to look at the post-news drift, you want to look at the trading intensity or the decision to pull from the market at an investor level. Then you can compare for the same events, for the same news, specialist versus generalist. You can have some nice fixed effect, to absorb the news itself and compare across, different specialized specialists and generalists. And another thing I want to know is how many specialists for each of the news categories, right? All those are basic things are important, right? So I feel really you want to push even further on this, and this is not unconditional. This is a conditional statement, and in the test, I'll probably cluster standard errors, by time I'll use format best and to handle the code movement in the market rather than just the zero. And right now you're just clustering at a stock level. Okay, how much time I have? Maybe I'm gonna wrap it up because so overall I thought this is a super interesting paper and with very ambitious goals. It has novel insight on the the impact of specialized on market efficiency. I thought agenda is very clear, is impactful and is unique. And I think the key is to tighten up the measurement of the key variables, including also the inattention variables I didn't have a chance to get to, and some of the analysis, and more tightly test this prediction and the conditional prediction by Goldstein and Yan. And that will help you depend on the mechanism more clearly. And that's all I have. Thank you.
All right. Thank you very much, Yuehua, for the comments. Yijun, would you like to take a minute to respond before we move over?
Yes, I'd like to thank Yuehua a lot. So for you have mentioned 6 points, and each of them is very insightful and useful. So for the last one, the complementarity indeed is what we are trying. We are working very hard to think about how to push it. And your suggestion of the trading intensity is very helpful, and it's indeed what we should look at. So we will definitely take that into consideration and try to extend our analysis. Thank you so much.
Sure.
All right, great. Let me thank Yijun for the presentation and Yuehua for the discussion. It's great to have you in the series. And thank you everyone for attending. And I hope to see you in 2 weeks when we have Russell James from University of Kentucky with another topical subject of investment advice, if you can call it that way, from Wall Street Bets, one of those websites that was really quite popular lately. So thank you for today. See you in 2 weeks.